settled in.
Go ahead, spirit fingers.
Spirit fingers. Welcome to the home front, guys. Thank you for tuning in. Got Krista Campbell right here. I'm gonna let her introduce herself. I feel like I cut her off, and because she usually talks first in these things. So I'm just gonna shut up.
You did.
And let her do her thing.
But it's okay. I'm Krista Campbell with Waters International, buyer specialist in the Austin area, and we do this every week to help you as a potential home buyer, home seller, potentially answering questions that you may not have the answers to, or you may Google that and get the wrong answer. So we brought Brian Campbell back.
Hello.
He's one of our preferred lenders we work with, and he is here to help us talk about lender expert advice. So we have a ton of questions. We asked yesterday if you guys had any questions. As a first-time home buyer, we wrote down a ton of questions to ask. So I'm gonna let Evan kind of do his thing. Did you prepare for market update?
Huh?
No.
No, I don't have a market update for you guys today, but I will do it next time.
Okay. Well, thank you again for joining us this week and every week that you guys take your morning and spend it with us to like and comment and give us feedback. We appreciate it. We appreciate you. Yeah, please share it out. Okay, so we'll just kind of jump into the questions. If you have any questions, don't hesitate to put that down below, and then we will get that answered for you. We do have a ton to start off with. So we're kind of going to start from the frame of I'm a first-time home buyer and I don't know anything, which we get a lot of those questions a lot of times. Do you have one you want to start off with?
Yeah. So, Brian, first question that we got submitted, and the one I want to ask you is, I guess, what's the main indicator to know if I'm ready to buy a home? What do you look at first?
Okay, cool. So yeah, the first thing that we tell our customers is that the number one thing that lenders look at is your credit.
Okay, credit.
So typically, and we talked about this on previous episodes, the minimum credit score requirement for most lending is a 580. But if you're in that range, then you may be ready to go. It'd just be worth getting in touch with a lender and having them review your credit and see where you stand. Ideally, you're going to be 600, 620 or better for most programs. The ones below 620 are going to be tougher to get qualified for, but it doesn't rule you out, so it's always worth asking. But if you're tired of renting or ready to own, you're definitely going to be looking at the credit first, and then income, assets, things like that come into play afterwards.
Gotcha. Okay. Thanks, Brian.
Thank you. Yeah, I have a question. What would be the difference? What's the difference in a conventional and an FHA loan?
So a conventional loan does require a 620 minimum credit score. Both types of loans are good. You can be a first-time home buyer for either one. An FHA loan can be a little bit easier to get qualified for. It has some requirements that are kinder to your debt compared to your income, to your credit scores and things like that. If you're a first-time home buyer, there is a conventional loan that you can do 3% down. FHA is 3.5% down. Both you can use with bond programs or down payment assistance programs to help you cover that down payment. So, the differences are, though, on an FHA loan, if your credit scores are lower, it's going to be kinder to you when it comes to your interest rate, and it's going to be a little bit kinder to you when it comes to your private mortgage insurance. So you could actually get a lower overall payment by going FHA. The drawbacks to going FHA is that mortgage insurance that's on that loan, the private mortgage insurance, never really goes away. So that's there forever unless you refinance and pay money to refinance a loan or sell the property. If you put 10% down on an FHA loan, the mortgage insurance will go away after 10 years, which doesn't really help in most situations. So it just kind of depends on the overall scenario for the borrower. We talk about that a lot. If you've got lower debt to income ratios, good credit, then the conventional loan can be a better loan because you can still get good rates and then get rid of the PMI. Or if you're putting a large down payment down, conventional is always better because if you're putting 20% down or more, you don't have to worry about the PMI in the first place. On an FHA loan, even if you put 50% down, you're still paying private mortgage insurance. And so it wouldn't make sense to do FHA in most cases with a large down payment.
Okay, gotcha. So Brian, we had somebody wanted to know. I'm thinking about changing jobs. Do I have to wait 6 months to apply for a loan?
No. So that's a common kind of a myth out there. The only real time that you have to wait 6 months is if you've been out of the workforce for a good while. FHA requires that you're back on the job for at least 6 months. But in most cases, as long as you've got a 2-year work history, or you were in school and then you're kind of in the same line of work that you went to school for or whatever, then you can, let's say you've been working any job, rather than self-employed, you've been working and then you decide to switch jobs up. If it's a salary position, if we've got the letter to show when your start date is and what your income's going to be, then we can actually close a loan up to 60 days before that job actually starts. So that's perfect for somebody that's relocating from out of state. Hey, I'm working for Dell. They've offered me a position. I start on August the 15th. We can close June 15th knowing that they're going to start within 60 days and use that income to qualify you. So if it's a hourly position, then we can do a verification of employment when you start. A lot of times we might have to wait for you to get your first pay stub or a couple of pay stubs to show what your average hours are, that you're averaging 40 hours a week or whatever. But you do not have to, in most cases, there's no 6 month wait period unless you've been out of work for quite a while. And that's on FHA.
What about conventional?
Conventional, as long as you show you've had a 2-year work history, and so you could have been out of work, but you worked, let's say you had a child and you were a stay-at-home mom or dad. As long as you show that you've worked 2 years in the past and we can show that work history, then you can start a new job and there's no time frame to wait.
So it doesn't have to be like consecutive.
Consecutive, that's right.
Just generally speaking, 2 years of work history.
Yes, ma'am.
Okay. So I get this a lot. My credit's not good. What's the minimum credit score, which we kind of talked about, but do you have to pull my credit? I mean, it's going to hurt my credit to pull it now.
So I've got a service that we recommend that's a soft credit pull. If your credit is, if you've got different services and you're seeing your credit and you think it's fairly low, then you may not want to let a lender pull it because it is a hard inquiry in most cases. We do hard inquiries, most lenders that I do know, hard inquiries. So you might want to use a service to do a soft inquiry, and then maybe you can let your lender look at it and give you some advice. But if you know your credit's fairly low, you probably want to stay away from the hard inquiries and get it pulled through a service that'll allow it to not be, you can pull it multiple times every month or whatever to keep an eye on it. But I would always tell people that have low credit, get your credit report pulled through this service or this service. Get me a copy. That's not going to be what your actual mortgage credit report is, but it'll give me a good indicator of what's going on with your debt and, what your ballpark credit scores are. So I can say, hey, here's what you need to do, or you need to talk to somebody in credit repair that knows more than I may. Sometimes your credit's just low due to credit card balances, and so if you got a credit card with $1,000 limit that stays at $900 all the time, then that's not helping your credit. You need to keep it down below a certain percentage.
Okay.
So if it's low and somebody says, my credit is 560, what would you say? I mean, because I get a lot of that where it's like, oh, it's low, I need to repair it. But you don't necessarily need to repair it. That's what I tell people. It may just be just doing a couple of things. Yeah,
we work with a couple of good credit advisors, and again, I don't want to pull your credit necessarily unless you just know what's going on with your credit report. So if you say, well, I'm maxed out on all my credit cards, and that's a good indicator that it could be that you just need to pay those down. But we kind of dig a little bit further. Have you been late on anything, any judgments, any collections, things like that? Those are things that can also be bringing it down. Multiple credit inquiries could be hurting you. So I kind of analyze the scenario with each individual and find out what's happened with their credit recently, and if it's just we've been struggling to pay down credit cards, then we may go ahead and look at it at that time just to say, hey, this is what you need to do. But a lot of times if they're fairly low like that, then you might just want to pass them over to somebody that does credit repair to at least have a conversation with them and show them how to do a soft credit pull.
Gotcha. So I guess what moral of the story is to talk with Brian first.
Always have the conversation, but I even tell him sometimes, because I don't know what my credit is. I tell him to start with Credit Karma, find out what your credit is.
Yeah.
And you can also do a free annual pull.
Shout outs, there are people that are
Thank you,
joining us.
Susanna, for joining.
Yeah.
And she has a question
She has
too.
a question, but we'll finish.
We'll finish going through this.
Yeah, I would say that, on Credit Karma, you just want to, you want to be to know that when you do a mortgage credit report, there's a different algorithm that's used to determine your scores. So we use 3. If there's one borrower, we'll just use the middle credit score of all 3 scores that come up: Experian, TransUnion, and Equifax. If there's 2 borrowers, we use the lowest middle score between the 2 borrowers. And so Credit Karma a lot of times will show a different score than what we actually see. So if somebody says they pulled their score on Credit Karma and they got a 600, it could be lower than that, but we can always look at it and see. Also on that, if you've got a husband and a wife, and let's say the wife has a 700 credit score and she makes lesser money, but the husband has a higher income and he has a 580 credit score, then we have to go off that lower credit score. So it may be more complicated getting both qualified for the loan. So
It's good information. Right. And Susanna asked, what constitutes a soft pull of credit?
What constitutes? It's just I don't really know the answer to that question. It's just a service that you can do through most of the Credit Karmas out there. There's several services out there. If you Google credit repair and things like that, or credit inquiries, and if it says soft, then you're still seeing everything that's on your credit. It's just not an actual hard inquiry. I don't know how it actually works.
It doesn't touch your credit, right? It doesn't.
No, it doesn't hurt your credit.
It doesn't come up to your credit as an inquiry.
So that's what you're looking for. If you're buying a house in the future, and you know that you need to work on your credit, or even if you don't need to work on your credit, you just want to kind of know what's going on with your credit so you can be prepared. Get with a service that, and you can contact us. We've got a great service that you can use. It's, there's a monthly fee, I think, of, $10, $11 or something like that can be canceled at any time. But the idea is to have a service to where you're always, knowledgeable about what's going on with your credit. And you don't want to go every time you're wondering about your credit and go do a hard inquiry, right? So as an example, a lot of people think that they have really good credit or higher credit than they really do. And we find that a lot of times you'll get your credit report and find out that there's medical collections. And for whatever reason, I get the medical billing system, people don't know that they've got bills a lot of times. Maybe they went to a doctor and had some lab work or something done like that and never saw the bill. They paid their doctor their bill but never got a bill for whatever reason. Maybe they moved, changed addresses, whatever else. So people that'll have an immaculate credit history, pay everything on time, have no problem paying a $80 bill, that's on their credit a lot of time. That does actually affect your credit report. So it's good to kind of have some kind of a monitoring service to know, one, if there's anything popping up out there that you weren't aware of, and two, if there's any kind of fraudulent activity going on too. There's a lot of that stuff out there too. People getting credit cards in your name and so on and so forth. So I would recommend always using a credit monitoring service to just be able to go in and pull your report anytime you want. Pull it every day if you want. It's not going to affect your credit whatsoever. So
that's good advice.
Gotcha.
And there is a lot, because I will tell you from experience, when I was purchasing my house, there was another Krista Campbell that wasn't paying her bills in Florida, and she ended up merged on my credit report. So that was like the worst 30 days.
right.
I have about $5,000. Is that enough to make to buy a house?
It could be. It depends on the scenario. There are programs that allow zero down. There still are closing costs. We talked about this before. So if you qualify, if you're a veteran, which is a zero down program, there's closing costs involved, but you can either get the seller to help pay your closing costs, or you can get a down payment assistance program to help pay your closing costs. There's USDA, which is the same kind of deal. There are 3% down conventional loans. So if you're buying a house that, $5,000 would cover the 3%, and then you have the seller pay the closing costs, or you got a bond loan, then that would work. Same thing with FHA, 3.5% down. So it just kind of matters. I'd say $5,000 is, unless you're doing a VA loan or a USDA loan, is going to be tough to cover everything, unless you include a down payment assistance program to cover the remainder, or you get seller concessions, which you can talk to your real estate agents to discuss what seller concessions are and how to negotiate that in a contract, and if it's a good idea with the market you're in.
Gotcha. Okay.
What is a bond loan?
Yeah, that is a good question. You mentioned that a couple times.
Yeah, there's several different grants out there that are sponsored by the state, city governments, and they're just either second liens or grants that some of them you have to pay back if you sell the house. Others you don't pay them back, and you just have to qualify for them. So there's different criteria. There's income restrictions on some of them, on most of them. There are credit score requirements. There's debt to income ratio requirements. Some bonds are available in different zip codes, things like that allow for more and don't have income restrictions. So just if you need any kind of down payment assistance, just talk to your lender, talk to me, hopefully, and I'll do an application with you, and whatever area you're looking to buy, I'll give you all the options for different down payment assistance programs. We always tell our buyers that if you're needing to do a down payment assistance program, you're not going to get the interest rates that you're seeing out there for normal 30-year fixed mortgages, 15-year fixed, whatever. You're going to see an increase on the rate because they've got to help cover how to pay that. You're not going to get the 4.5% that you're seeing, or the lower or higher rates that you're seeing out there. So you're paying for it a little bit somewhere, but you're still able to get into a home, and maybe down the road you can look into, rates go down and you're in a better position, you can look at refinancing into a better rate if it makes sense.
Gotcha. Brian, I had a question from a potential client. He wanted to know, he works on a car lot, he gets paid commission, he's been working there for 6 months. How would that work? Would he be able to qualify for a loan?
No. We could use any kind of a base salary, but in most cases, a commission borrower, you're going to have a 2-year history, because they're essentially self-employed. You're going to have to kind of find out what their averages are. So in most scenarios, you have to have a 2-year history.
Okay, so if you're commissioned or self-employed, 2-year history.
In some cases, we can do a little less, but I would just have to look at the scenario. But you're typically looking at a 2-year average, just like with self-employment.
What about waitresses?
Well, you're looking at your hourly, which is fairly low in the restaurant business. So you're looking at tip income. So you're looking at the averages on that.
You need 2 years for that.
No, you don't need a 2-year history, but
Okay.
You have to look at what they're averaging out, and then you look at the history of what they've been doing, and that's a little bit different.
Okay. What about if you have what they call thin credit, meaning I just have a car loan? Can I get qualified?
Well, you've got to have credit scores. So, when we get a loan in or an application, we run it through one of the underwriting engines for Fannie Mae, Freddie, FHA, different ones, and sometimes if there's not a huge credit history but the overall profile looks pretty good, you can get an approval on it. Sometimes you get sometimes you may get a refer, or typically you just need to show that you're showing scores, and then the system will look at your overall credit profile. If you've got credit scores but all your credit's brand new, you may not get an accept or an approval through the underwriting engine to say you're good to go. You might have to add on a co-borrower or have some more history of credit to be able to qualify.
So what do you recommend if someone doesn't have much credit and they need a co-borrower?
Well, if they don't have much credit, and we either recommend hey, talk to one of our people that we recommend for credit, one of our credit experts, and kind of give you some ideas on how to obtain the best, whether it be installment debt or credit cards or whatever. They can kind of give you some good ideas on what to do to build your credit. Or if if you want to add a co-borrower to the loan, then that person would obviously need to have a good credit history. And then with the two of you combined, sometimes with the overall strength of the file, you may get an accept at that point because you've got some extra factors there to help to have the system like what you qualify for.
Gotcha. So Brian, I had another person that wanted to know, they're a teacher by day, Uber driver at night. Can they use both incomes to qualify for the loan?
Well, the teacher position would be their full-time position. We can obviously use that. Secondary job income, we need a 2-year history of that. So.
What if they only are an Uber driver?
Need a 2-year history of that. It's you just need to show that what they're averaging out over a 2-year period. It's kind of like a self-employed borrower there, so you need to see an average.
Gotcha. Okay. And then, like you said, if they're relocating from another state, they need, and they don't have an offer letter, but they do intend on getting a job, here in Texas. Do they? They have to have the job, right, before they move over here.
Yeah, and that can be tough sometimes, right? Because you're like, well, how do we know where to live if we don't, have the job yet? So a lot of times people will want to come in and rent for a while until they can find out where they want to be and so on and so forth. But I can't use income from another state that they currently have, knowing that they're going to come and move here make this a primary residence.
Mm-hmm.
So we would have to have information about their new job, and if there's an hourly position, they would need to have actually started, and that way after they start, we can validate their averages.
Right, and they don't have to necessarily wait the 6 month.
No, they don't have to wait 6 months unless
Okay.
there's been a huge job gap and it's a certain type of loan, then we have to wait. Only on FHA is when we have to wait 6 months if they've had a large job gap.
Gotcha. All right. Any more questions from the viewers, Kristen, that you
I
have?
don't think so at this time.
Cool.
I think we covered everything.
We covered everything, guys. Thank you for tuning in, checking into the home front today. We wanted to talk to you guys about how to know if you are ready to purchase a home. Just to kind of recap of what we talked about. We talked about, the most important thing that a lender looks at when determining you are ready to buy a home is your credit, guys. That's the number one thing that they looked at. So if you have questions about your credit, get with myself, get with Brian, and we can put you in the right direction or point you in the right direction of what you guys need to do next to either increase that credit score or, who knows, now may be the right time for you guys.
And you don't need a 700. You can be as low as a 580. But
Good point.
you do need certain factors if you have a score that low. And potentially at least as low as a 620 can give you a lot more options. So it's really not as bad as people think, unless you're at like a 400. That's not happening.
And also, too, guys, in this video, we talked about you do not have to wait 6 months if you change the job to see if you qualify for a loan. So that's absolutely a myth. Talk with, like I said, get with me or Krista, or get with Brian to see if now is the right time for you. If you guys are doing commission-based sales or you guys are self-employed, we need at least a 2 years worth of credit history. And Brian, correct me if I'm wrong with all this stuff.
Work history.
Work history. Okay.
Of that in that job.
Okay.
In the industry, because what if you're like in a contractor that's receives W-2, but you're still considered a contractor in that type of role? You get 6 month position.
Yeah, you can, if you've got a history as a contractor in the same type of work. That happens a lot in the IT business locally.
Mm-hmm.
A lot of people that do IT work will have contracts. We just have to show the history of them doing that and how they write their, because they're 1099. Now they could be W-2'd also, but it's still, the job ends. We just have to show a history of it. So it just depends on the individual.
Okay.
But yeah, you can start a new contract with but if you've been doing the same thing, the same line of business, we do this all the time, and you don't have to have a 2-year history with the new company. You've been doing that already. Now, if you get hired as a temp employee or contract employee, and you haven't really done it before, sometimes you'll have situations to where they're going to hire you under contract, and then after a certain period of time they'll hire you full time. You have to have a history of doing that too for us to work. It just can't be they're going to pay you $50,000. It's contract, so you have to have a history of doing that. Typically, on any type of that work, you have to have a full history, unless the contract says you're guaranteed, and it gives it. There's no end date inside. So.
Gotcha.
Okay.
Cool.
Yeah, I think that was a lot of good information. If you guys have any more questions, feel free to send us a message. We will get those answered for you. Or if you have any additional topics you'd like to talk about, please let us know. And thank you again for joining us.
Thanks, guys.
Spirit fingers.
Bye.